Hi, this is Kurt Kringles, Head of Credit Strategy for Voya Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. The high yield market recovered some lost ground in August with a solid performance while the rest of the fixed income sectors traded sideways. The high yield market suffered a disproportionately large sell-off in July while the other fixed income sectors held relatively steady. The net result for the last 2 months was a mild leakage of excess returns across all of the fixed income sectors. Strong U.S. economic data was not enough to outweigh economic weakness in Europe and uncertainty surrounding the timing of interest rate hikes by the Federal Reserve. Elevated geopolitical tensions also were not helpful. Within the U.S. investment-grade corporate market, the basic industry was the only industry to deliver positive excess returns for the month. U.S. economic data was generally strong and likely contributed to the relative strength in economically sensitive industries such as the basic, technology, and consumer industries. The higher quality nature of some of these industries also helped during the recent market weakness. Despite the U.S. economic strength, Treasury yields followed global government yields lower and put pressure on spreads of long-duration corporate bonds. Consequently, the longer duration utility and communications industries underperformed the market. The energy industry also lagged as oil prices continued to decline. On a year-to-date basis, market leadership has narrowed, with the communications and basic industries now holding substantial leads over the rest of the market. The higher quality technology industry has gained notable ground, while the energy and utility industries have lost their market leadership positions during the past few months. The decline in Treasury yields has hurt the performance of the relatively long-duration utility industry, while weakness in oil prices has hurt the performance of the energy industry. While there has been some ebbing and flowing, year-to-date excess return performance remains tightly clustered for the bulk of the market. Our tactical outlook for the corporate market remains relatively neutral. Heavy new issue supply and relatively tight valuations open the door to some upward drift in spreads. While we expect investor demand to be relatively stable, new issue supply for September will probably be the highest monthly total for the year and could pressure spreads. In addition, further strength in U.S. economic data could be both a blessing and a curse. Healthy economic activity is generally supportive of spreads through improvements in corporate earnings, but there is the potential of an offset related to concerns about the possibility of an earlier-than-expected Fed interest rate hike. Geopolitical tensions and weakness in Europe also have the potential to weigh on spreads.